This is Ron Gallagher at PAMIC, welcoming you to the topic of risk management fundamentals. Before I turn the course over to Jack Yanowski, I just want to make one comment for you. Next Thursday, January 28th, starting at 2 o'clock, PAMIC will be doing a live webcast and featuring David Buono, the Insurance Consumer Liaison. You'll have a chance to hear him live and to ask questions during that 1 hour news format. So with that, Jack, I'm going to send the presentation to you, and you can start your work.
Good afternoon. And we're getting ready to roll here. Risk management. It's a little bit of a different, but I will remember that over 30 years ago when I first took a course in risk management, the instructor made mention that risk management is an oxymoron amongst itself. It is really the science of adding certainty to uncertainty. And that's the basis of risk management. You're going to add certainty to an uncertain event. The primary function of risk management, of course, is loss control and loss prevention. And then if you look in your first screen, you will see that where it goes to in the world of finance, it's the loss of asset value and loss of property value. And these are key functions to an insurance company, because in any area where there is the risk exceeds what was the expected loss and claims, then the insurance company has to raise premiums. And when they start to see premium increases and the competitors aren't, then they become less competitive. They start losing business, and again, they're losing revenue. So there are very key functions performed in risk management. The risk management environment, again, involves all facets of the insurance operation. The benefits to the insurance company in this case would be reduction of the hazard of risk, reduction in paying out claims for perils that they do cover. The overall general underwriting is very key in risk management, and underwriting is a function of risk management. Some folks may not think it is, but it's the first step in risk management in covering what business is on the street for the insurance company. Naturally, claims management comes in the event when they start dealing with the losses and how they could be prevented. And then you bring in your risk managers, which is now they analyze, why did we take this risk? What happened at this risk? The legal requirements that they have to pay that claim timely and according to the policy. All of these come into the overall scheme of handling that risk. And all a risk really is the potential for a claim to occur under a covered peril. Okay, so I present a risk to the insurance company in where I live, my home, the area my home is located in, where I drive, the area where I drive, how far I drive, the vehicles I drive, all of those things, the number of drivers in the home, all of those things present a risk to the insurance company. In the underwriting side of the risk management is when they line up everything and it says, we can accept this risk at this cost, at this premium. Okay. If they're not doing it properly, what is happening is they're going to expend more money to control these risks than what they should. And that is, as you go through it, you're going not to commit your productive resources in the proper scope of managing those risks. Okay. So there's steps to be taken into it. The 6 steps in the risk management process. The first 3 are kind of focused. They are to identify the risk, analyze what will occur, and examine it. Then once they have these three areas, then you sort of dial the rule 180 degrees, and you go to selecting the appropriate process to control that risk, implement that process, and then it's not a final unit. One thing about risk management is that it is an ongoing and evolving process. So once the risk managers have established their protocols, now they have to monitor the business that's coming in, that's still going through underwriting, the claims that are being paid out, and if that process needs revised, it has to be revised as necessary. So your risk managers are very key, and they are always analyzing that data. So they're identifying what comes in. So there were times prior to Act 6, and if any of you have been in the business more than 26 years, then you lived the pre-days of before Act 6 of 1990, which revised the personal insurance laws, personal vehicle for motor vehicle financial responsibility law is what it's actually called. But before that, there were some companies, and there are still some companies today that use what agents may term it, underwriters may even use the term as zero underwriting. No tickets, no accidents. You got to be squeaky clean. And then there are times when they will say, well, you have to have at least one vehicle that's less than 5 years old and it has to have physical damage on it. They put these barriers on it. Now, under the Act 6, they've sort of relaxed that a little bit. There are still, though, in the preferred tiers, companies have gone to tiering, and in the preferred, the best rate tiers, you're going to have newer vehicles. You're going to have higher limits. You're going to have zero underwriting. Those review that, and as the company becomes profitable, they may analyze it and say, well, we can get more business in here. So that is why risk management in the last step of the 6 is an evolving and correcting process, and they have to be able to do that. Then as we move forward, you get with a very valuable takeaway in that portion of it. Reducing economic uncertainty improves productivity and improves profits to a company. So that's the first takeaway that you're going to get in those areas. Risk management is critical in reducing the economic exposures of uncertainty. They have to analyze it. So you have to share that information within the company, and it has to be shared.
So, Jack, before you go on, I have a question for you. So earlier you said that risk management starts with actually underwriting, which I'm going to assume actually starts at the time that an application is made. So what are some examples that companies have used to implement some risk management tools to correct potential problems that they were seeing in their book of business?
Well, they can, like I said earlier, they've gone to zero. If they were taking some before, they would be saying, okay, we'll take an accident that occurred within the past 5 years. If there was no suspension of licenses, just it was a freaky accident, they slid. Okay. If they see that we're writing a lot of business with one accident and they start analyzing it, and there is a lot of data out there, and so I will spin off after this, but they will look at that and they will say, we have to stop doing that. So we're going to have to go back and we're going to have to establish the underwriting guideline that we can have no accidents in the past 5 years or 3 years, whatever they want to ask on their application. There is a presumption that goes out there that if you had an application that came in to an underwriter and the underwriter looked at it and there was no losses, and they just did a survey and they said that these people haven't had an accident in 19 years. Historically, when you start aggregating the data in the loss criteria, you're going to find that if someone hasn't had an accident in 20 years, that they're going to have one in the next couple of years. And risk managers know that. Now, you can't just refuse to write it because they have a clean record. Also, they've also looked at in the past that if someone's had an accident within the past 2 years that has been minor, we'll just say like $2,000, the numbers show that within the next 3 years, they're going to have another one, and it's going to be significant. That's just the way claims seem to play out. And underwriters have to be on their toes for that. And that's why a lot of companies in their preferred tiers will not take anything where there's been any claims within 5 years, because if there's only one, they're probably going to have a second one. And that affects that entire book of business. So underwriting starts there. Now, a lot of it, when you have appointed producers, they should be doing a lot of that. And one of the things that they do now, more so than they did 20 years ago, is they pull MVRs. It used to be agents didn't pull the MVR. The underwriters had to pull it, and there's a cost to pull the MVR from PennDOT. So a lot of times they based it on where they could touch data. They would look at, there's no claims, no driving history there. There's no teenage drivers. They got a little more comfortable. But now they're finding out that with the data that's available, they can do a better underwriting scope. And a lot of companies have relaxed it, where they've taken the underwriting side of the risk management process and saying, okay, we'll make an exception and we'll take it for this. They had this accident, and the underwriters have some flexibility. But at any point in time that becomes an issue, they turn around and will close the book down and go to whatever strict guidelines they wish to impose. So there are three elements in the types of exposures that come across, okay? And the first one is the cost of the loss, okay? There is real and potential values in those areas. You have the reduced economic value. You have the loss of net benefits to the carrier. That's a potential loss anytime there are claims. So if there's a major claim, a major fire, okay, you would have, and the company sets back $80,000 in reserves. Now they have $80,000 of their money tied up, okay? If they have to pay out $70,000, in theory, they have not had the same loss, the actual loss, as the potential loss was. However, if there's other issues that come up, they may end up paying over $100,000, and so there's an additional loss to net, and they have to move money out of reserves to cover that. So that is, very key when they're starting to establish it. And there's always been a little, sometimes companies will set reserves a little bit too high. Sometimes they shouldn't set them that high. That does have an effect on them, but they do recover at the end. And then there's the losses. There's a cost to the company just for handling the claim, even if they don't have to pay the claim. If it would turn out that it's not covered, or if it was an auto accident, or there's a homeowner's loss that was caused by a third party and they subrogate and recover all their money, they still have the management cost of that. So in almost every claim, there is a loss experienced by the carrier of some type. Financial is always a key on that, as to what we're going to pay, what do we have to defend it, and this and that. So you end up with the types of losses that are coming down along the line. Your loss exposures, okay? There's a loss in property value. Now, to the insurance company itself, it's really not losing its property value in its offices or anything by having claims on homeowners out there, but they are losing value in their reserves and what they have. So they can't expand and buy new technology if they're having excessive claims, because they don't have the resources for it. And then that affects it. There's also the liability loss exposure whenever there's claims out there. If there's auto accidents, and so there's going to be litigation, there's going to be suits. Even if they successfully defend the suit, they have litigation costs. And then, of course, if there's sickness, there's injuries, there's time off, there's the loss of human value or human resources. And then, of course, there's income loss. Those are loss exposures every business faces in some manner every day. Risk management, the focus of risk management is to reduce or eliminate the potential in those losses. So the whole focus of risk management, again, like I said before, is to add certainty to uncertainty. So what they try to do is take a look at these claims, and they look at the historical values. Well, we had these types of losses in this. So we have homes that are built before 1960. We seem to have a higher loss than we do with homes built after 1960 or 1970 or 8, whatever time frame they're looking at. And they will look at these time frames, and they will analyze these. And that is why you will see a lot of times, if there are homes that are built before a certain time frame, they will use a different cost estimator on those homes. Now, typically, homes built in the early part of the 20th century, if it was, they had plaster walls, they had 2x4s that were 2x4s, they were larger. They may have had 10-foot ceilings. They were larger rooms. They had fireplaces. These homes were different than the constructions used today. If you have to go back in and rebuild that, and your building materials are standardized for today, you're going to have to buy excess building materials to repair that home. So that is the reason a lot of folks will say, I don't understand why I have a home that's built in 1950 and my kid has a home that's built in 1980. My insurance costs more and I have this, and this. It's because when they do the replacement cost estimation, there's more cost to restore an older home. Risk managers do analyze that. And if they're not analyzing it properly, then they're going to have a period of time where there's loss of property value to the company in those claims.
So Jack, getting back to how companies can implement some risk management tools to minimize their exposures to the marketplace and still offer a product. So we talked a little bit about on the front end with their application that they could ask more specific questions to gain more information to help make a more informed decision. Now, what about in terms of policy design? So, for example, I noticed when I was at the insurance department over the last couple of years that companies were coming in with changes to their policy on certain types of coverages. The big ones used to be the amount of coverage they're willing to offer on guns or on jewelry and on other kinds of personal property items by establishing newer limits on the total loss. Are those the kind of things that are considered risk management tools by the company?
They would be. They would come into the claims area. What the risk managers would be looking at, in this case, jewelry. Okay, if there's a fire loss or a theft, what is the average value in those losses? Okay, and it's no big shock that the amount of value that people had 25 years ago and the amount of value they have today are quite different. Now there's other ways to do it. The companies are doing that by limiting coverage on the homeowner's policy, saying to an aggregate of $5,000. Well, $5,000 can be consumed in jewelry in a heartbeat. So what you do is, the agent should be doing, and almost every company offers it, is you're going to have to add an inland marine policy and cover things for higher limits than what is accepted on the homeowners, or go in and ask for higher coverage on that. But the claims managers, when the claims folks are settling these claims, they'll be entering this data. The risk manager is going to be looking at it, just like TVs have changed. Okay, a couple years ago you had a $400 TV. Now people have $4,000 TVs that are 75 inches across. I do know of a claim that occurred here. I don't know the company. I just know a friend of mine. He had a company haul a TV on his wall, and apparently they didn't anchor it right, and the TV fell. Not only did it basically destroyed the TV, but it damaged the wall when it pulled free. So you have a dwelling claim there. You have a content claim. Ultimately, I don't know how it might go. He files it with his homeowners, where the homeowners will subrogate to the company who installed it. But, 10 years ago, that was probably an unheard of claim. But here you have significant damage to the walls, and a brand new TV that's out a couple $1,000s. So there's a claim there. Will risk managers respond? Maybe, maybe not. If there's an influx of those type of claims, they're going to be looking and saying, hey, we're going to tell people we're going to limit coverage if they hang a TV on the wall.
Okay.
Because, okay,
All
so
right, thank you.
that's how they'll look at it. Okay, there's a multiple type of loss exposures. Okay, you have the loss exposures to tangible and intangible property. Okay, tangible property, I mean, that's just what I described, the big screen TV, jewelry. Intangible property, those are copyrights, patents, manuscripts, and that's why you see if you rent a DVD, you'll see that it's protected. Okay, so and piracy is a crime and things of that nature, flashes on the screen. Those are the warnings to that there's potential criminal activity and there's a potential loss to the person that has that copyright. That's intangible property. Liability loss exposures, well, for insurance companies, yeah, you have the breach of contract, breach of duty, and what will happen is, in a lot of cases, that the bigger liability that an insurance company may face from not handling a claim properly would be being sued for bad faith. And under bad faith, you can be sued for treble damages. Of course, the thing that leads to bad faith is breach of contract. They didn't pay the claim, and the insureds and their legal representatives are saying that you breached the contract by not paying the claim properly or paying it at all, and that you drug it out for a number of years, and now we're going to sue you for bad faith. And that becomes a liability exposure to an insurance company. And other folks can have the same thing. You could have two contractors where a subcontractor gets sued by the primary contractor, general contractor, for breach of contract, that they didn't do something that they were supposed to have done that cost the contractor money in their liability. And there you may have a liability issue. If the subcontractor's insurance has to respond, the company has to set reserves, et cetera. You have personnel loss exposures.
Jack, before you move on to the personal
Okay.
loss exposures,
Mm-hmm.
when I think about a liability loss exposure, I'm actually thinking it from the policyholder's perspective, such as a dog bite to a neighbor or
Okay.
something like that. How would a risk manager typically respond, or how has risk managers typically responded to that type of exposure with their policyholder?
Well, dog bites, they'll start looking at the breed of the dog. So they'll look at overall. They say they have 50 dog bites in the prior year, and 48 of those were caused by one breed of dog. The next thing they'll do is say, we don't write this. We don't write this risk. Okay, well, if they have this dog, this breed of dog, we don't want the risk because it's gone against us, where we've been paying out claims that are excessive because of that. If it's scattered all over the place, they have 50 bites and it's 50 different breeds, they're just going to have to take a look at, okay, is the dog house kept, pen kept? Is it, do you have a fence and the dog roams the yard, or do you have nothing on it? So there's other avenues they would look at, but if they do see a particular breed, then they will tell them, no, we don't write that.
So where would a risk manager in a company start identifying some of these types of things so that an underwriter, whether it's field underwriting with the agent or it's the actual underwriter at the company, where would these items show up so that an underwriter knew what the rule was?
The risk manager will take a look at the claim data, and then what will happen is the company will adjust their guidelines, underwriting guidelines, that, okay, we're not taking this type of risk. We're not writing a home that's built here. We're not writing this type of dog, because the propensity of the losses, they are not profitable. And regardless of what anybody says, insurance companies aren't charities. They're there to make money, and they're there to make a profit. And if they don't do it, one of two things will happen. They'll either have to continually raise premiums to where they become non-competitive and they're losing business to their competitors, or they'll end up becoming an insolvent company and going out of business. So they have to remain viable, and their underwriting guidelines are key on that.
Thank you.
But they can't be discriminatory. Okay, if you're not going to write one breed of dog, you can't write that breed of dog for somebody else because they know somebody or they're friends with somebody or they work there. You have to draw the line and say, we don't write this, we don't write this breed of dog, we don't write it for anyone. So, the next type of loss exposure would be personnel, and it's not the cost of administering personnel, it's not the cost of hiring people. What you're talking about here generally is the loss of a key individual by death, disability, retirement. Someone that's key to the organization leaves. However, either by death, disability, or retirement, the cost to replace that person. Okay, there's always a break in there unless you've had the opportunity to bring somebody on and mentor them for a period of time. The new person walks in. Now, one of the problems with the state is that the way the state is, you cannot fill a position until it's vacant. So, if a deputy's leaving or a key director or a key manager is leaving, you can't put somebody in there until they're gone. So you really can't hire somebody to shadow them because they're not structured that way. Private industry can do that, though. They could bring somebody in to shadow the other person so that they have an idea. So on day one, they're doing it. But that's that type of cost. That's a loss exposure because if you bring in somebody in, they're going to have to be paid. They're going to have to receive all the benefits. Everything is the same. So you basically have double cost at that point in time. And then, of course, you always have your the net income loss where you're losing money from operations or other issues, and it has to be corrected in that manner. Okay. Mm-hmm. Okay. Now, some of the tools used by the risk managers, and if you look at these, and if any of you are claims people or underwriters, you're probably going to say, well, I use that too. The risk management questionnaire or a questionnaire. Underwriting questionnaires go out all the time. Underwriters use them. And even when you're re-underwriting, for the lack of a better term, you had a risk that's been on there for 5 years, you send the question out, how do you use this? Are you still driving this many miles with this, and this? The questionnaire is probably the easiest to use and probably the easiest for the individual that receives it to complete, and also the easiest for the individual to complete to shade it. Okay, so questionnaires have strengths and they have weaknesses. The strength, they're easy. If they're constructed properly, they're easy to complete. But, if you ask on there, how far do you drive to work? And they put down 3 miles one way when they really drive 30. Is it an oversight that they left the zero off? But that affects the underwriting of it because if you were looking 3 miles one way, 6 miles, less than 30 miles a week, that may give one rate to the auto, where more than 30 miles, less than 100 might give a rate. And if they're driving 30 miles one way a day, they're over 100 miles. Maybe they're using the car in business. So the questionnaire will help if it's easy and it's answered correctly, but it's easy to shade it. There has to be other follow-ups in that. The next one is loss history. Okay, so, and underwriters do this all the time. Agents should do this. We're talking about pulling the MVR. If you're doing a homeowners, you can go to the MIB and pull claims on the home. Have they filed any claims? Do they have any content claims? They have this, they have that. What's the claims history? If there's a propensity for loss and they're having constant claims, it's probably a piece of business you really don't want. If they have absolutely no claims, okay, well, you can take that risk, but you always have to go back and look at, usually there's a claim, everyone has a claim within 25 years of some type. The degree of that claim, well, depends on where it's going to fall. But if you're looking at 0-0 and they have no claims, you can be a little bit comfortable. The large numbers say that something's going to occur. You can look at, when you're looking at a business, if you're underwriting commercial business, you're underwriting workers' comp, you're going to want to see the financial records. because you're going to need to base that premium based on the payroll, and you're going to want accurate numbers there. You can get, when they're doing risk management, looking at what's the risk of that business, they can draw, the screen says other documents. The other documents would be like biographies of senior managers. How experienced are these senior managers? What's their background? What's their education? Are they all in this business less than 3 years, or do they have an aggregate? Are there service people? Are there some with 15, 20, some with 5, some with 8? What's the experience of that management team? And what are the bios of that management team? Obviously, if you're going to look at a construction company, and these people have the managers of that company have absolutely no experience in construction, no background in engineering, no business background, no business management background, that presents a greater risk than if you had those backgrounds on those senior managers. So the other documents can be very critical to risk management. You can look at an organizational chart. How's that organization structured? President, vice president, their typical structure, or is it a 5-person operation? You need to know that structure as to who's running it, who's accountable, what's going on. And naturally, underwriters will use inspections. I mean, you're going to underwrite a home. You want to see the home you're underwriting? Yeah, you can get photos. But if you send somebody out to do an actual inspection, it's done a lot on forums. They want to go out, they want to see the barns, they want to see how things are done. Those are critical. And all of these things that play into the front end with underwriting, and then during the claims process, the risk manager is going to analyze all of this at the end of the day and try to take a look at it and say, we need to fix this, we need to change this. And then you also look at the expertise of the people running it. All of that plays into the overall scheme of it, and it's not as easy as one would think, because you're taking all of the claims that have occurred. Those are the uncertain events, and you're trying to put certainty to those, saying that if we do this in the future, we won't pay these claims. These claims could be eliminated, or these claim values could be reduced by doing these safety measures, or this, or this, or this, or this. So it is a science. It is very similar to actuarial sciences. What it's doing is it's extracting one more area of it and saying, this is how we're going to try to reduce these claims so that these premiums can either come down, remain level, or what have you.
So, Jack, before you move on, many of the PAMIC members are medium to small size companies. Who would normally have the responsibility to oversee the entire risk management program, given that a lot of the companies don't have a person solely devoted to that function?
Probably a senior manager in claims, because they would, or maybe no one individual, like say a VP of underwriting and a VP of claims get together and take a look at, okay, well, this is what we're doing in underwriting, this is what we're doing in claims, and this is what we're ending up with. So they could do it that way, okay, because they would both have the experience to do it. And then the VP of underwriting could go back and tighten his underwriting up, and the claims person, I mean, a lot of times a claim will be paid that's a $2,000 claim that probably could maybe not even be due the person, but the cost of arguing it and setting up legal reserves saying we're going to deny it, and a lot of times it's feasible to pay it. But what they can do then is take a look at that and say, we do this, this, and this, we can eliminate these.
Okay, thank you.
Mm-hmm. There's 5 areas to analyze when you're doing the area. It's the frequency and the relative frequency, which is how often does this type of claim occur. Okay, when these types of claim occur, how severe are they? What's our potential for loss? Okay, And then, of course, the third comes down is to what did this actually cost us, the dollar cost of these claims. The fourth is the timing. Now, timing in this case isn't the timing of the claim, but it's the timing in the cycle, whether the company's looking at a January to December or a July to June. The timing in the cycle was how these losses are coming in and the payments are being made out. So, like, we'll just use Pennsylvania. We're probably coming into a time in Pennsylvania when timing of claims will increase for auto accidents, maybe homeowners. Okay, it's been very cold. It's been in the areas up north where I'm living. We've had a week of single digits, so you're going to see some frozen water lines, burst pipes. This weekend it's supposed to snow. Probably going to see an increase in the accidents. So in those timings of things, that's what the timing is. So claims go up. So the company has to be prepared, just like, people. You have higher utility bills in the winter because your heat is running more, you have this and that. So the timing and the payout. And that plays into actually analyzing the loss exposure, because if you have to have the money there to pay those claims, okay? And you have to take the data to analyze this, and that data has to be credible. So it has to be accurate. So when the other folks at the company, the claims folks and the underwriters, they just can't haphazardly put in the date, okay? Just by saying December of 2015, the risk manager might need to know, was it late December, early December? Because if we have a propensity of claims that occur in late December, why are we having a propensity of claims occur in December? What's going on out there? And they analyze that. All of that plays back into analyzing one loss or multiple losses. And the way they balance that and the way they address that is an attempt to, so that they commit resources there, productivity-wise, at the most feasible way, so that they're not overexpending resources for no reason, and basically, to be blunt, wasting money. Okay. Now we're going to go to some risk control techniques, and actually, they're people practices. The first one is avoidance. If you can avoid the risk, if you can avoid what's going to cause a claim, do it. There's proactive avoidance, which is your long and the short of it. You're analyzing things, and you're trying to analyze how can I not have this claim. And there's abandonment, which basically you just throw your hands up in the air and walk away. But avoidance, all businesses do that. Whether it's an insurance company or a construction company or a technology company, how to avoid the claim, how to avoid the risk of loss, the easiest and the most productive way. Then the second is, if I know I'm going to have a loss, how do I prevent if I can? So I believe the example they gave in the material was putting some type of protective device on a machine would be prevention, because now the person may not fall into it. When I first got out of college, I was working for Ford Motor Company. That's what they did. And around some of the machines where the parts would come out, it was a manufacturing plant, not an assembly plant. The sheet metal would come down. It was coming close to the individuals. If the sheet metal would cut you, it puts a significant cut. Sheet metal was very sharp, and when it's pressed into those draw dies, it becomes sharp edges even more. What they did is they took the conveyor belts and they made like a L shape on it, so that it was above all of the employees, so the sheet metal could not contact an employee. It's reduced, so it prevented injuries. You can still get cut because of just the nature of working on it, but that's prevention. Okay, and then you go to loss reduction. How can you basically reduce and eliminate that cost, that claim? If you have a dog that continually bites people, if you unfortunately have to get rid of the dog, you reduce the future claims. They're going to be non-existent. And then the last area of risk control is separation, duplication, and diversification. Now, what separation means, technology would be a good example of that. The insurance department has its licensing database backed up in two places. So if we lose the database, we can recover it. If the first place would lose it, we still have a third place. So that's basically separation, storing your data offsite someplace where you can get back, make the recovery without loss of productivity time. Duplication, that's sort of like you just make copies of records. So if you lose the one, you have the other. That's sort of like replicating the database and storing it. And diversification is breaking it out so that there's multiple faucets of it. It's diversified. And a good example of that is a financial portfolio, or the old expression, don't put all your eggs in one basket. You diversify so that if you do have a loss, you may not have to shut down. An industry would have diversification if they were buying off multiple suppliers, or if they are storing their materials in multiple places. We did a lot of remodeling on our house this year. I noticed that the Amish contractor was getting siding here, and this was here, and windows were here, and this was here. He was getting it from multiple suppliers. He deals with all those suppliers on everything, but if one of them doesn't have it, he's not hung by saying, I can't do the siding because I want to do the windows, and I can't get the windows. He can go to another place and get the same brand.
From an insurance company standpoint on diversification, would trying to reduce the concentration of exposures be a form of diversification? For example, when I was at the department, we had a situation where there was an agent who was selling homeowners policies in a new housing development. He happened to be a captive agent for a company, and as a result, most of the houses in that development were insured by one particular company. If they had appropriate risk management controls in place, would they be able to take a look at their concentration of risk and say, we're too concentrated, therefore we need to diversify and not sell so predominantly in one area?
Well, I'm not sure that it would affect that so much as on the nature of just writing homes in a geographic region, as it would be they would take a look at that diversification of, okay, we're writing in central Pennsylvania and we have this, we're writing in western Pennsylvania and we have this, and relatively we have more claims in western Pennsylvania than we do in central Pennsylvania. The form of diversification there would be to create ratings, separate ratings for the area. So you might be Territory 1, Territory 2, Territory 3, and within these geographic territories, we need this amount of money because the nature of the claims.
Okay.
So it'll be more diverse. Their diversification will be more that way rather than just rolling along and saying, well, we have too many homes in that area. Another area of diversification that property insurers don't cover, we'll just say, is earth movement and flood. There's no way to basically underwrite for that type of loss and charge a premium for that type of loss because of the magnitudes of the loss. And that was basically the reason they established NFIP. There's nothing in the Pennsylvania insurance laws that say a company can't cover flood. It's just something that, if you have it, even if you have a fire that goes through a street, you may have 4 or 5 homes. But it's unlikely if you have a flood that comes down there that you're going to lose 4 or 5 homes. You're probably going to lose the entire street.
Well, speaking about flood insurance, it's actually a hot topic at the federal level. Our insurance commissioner, Teresa Miller, who now chairs the NAIC Property and Casualty Committee, testified on behalf of the NAIC, asking Congress to change the National Flood Insurance Program and some of their requirements to promote the development of a private market for flood insurance. And in fact, in Pennsylvania, she actually did a data call in December and then followed up in January, writing to all the property writers, asking if they provide flood coverage, what do they provide, what are the limits, what are some of the underwriting guidelines for it, and so on and so forth. So it seems to me flood insurance is one of these things that is always a hot topic, but it just happens to be very, very hot topic right now in Pennsylvania.
This is the time of year for floods, because if you look at the Susquehanna, it's starting to ice up. And if it gets a fast thaw, if you get heavy rain and it's not thawed, you're going to have the runoff. And if you get a fast thaw, you're going to have it where the tributaries, they just can't handle it. So flood insurance it can be developed as in the private market. It's just, can the individual?
It's a pricing issue.
Pricing issue. Yeah, it's always going to be a pricing issue.
Okay.
Okay, risk financing techniques, transfer and retention. And these are not only used by risk managers and insurance companies. Transfer and retention in an insurance company would be how much we take on the primary responsibility and how much we take on the reinsurance. So if we'll say a company will write up to a $1 million home, but the company only front lines $300,000. That means they're paying a reinsurance premium for the other $700,000. So what they're doing is they're retaining the first $300,000 at their premium. They're quoting the excess premium that they're going to pay, charging it back to the insured, and transferring $700,000. That's how an insurance company would use transfer and retention. Businesses use transfer and retention, and they use it a lot in their health markets. They will self-insure. Big companies will self-insure, and they'll pay so much of a claim, and then they will buy a gatekeeper to transfer the risk back to an insurance company. That gatekeeper could be $50,000. So the business will say the first $50,000 in claims, we pay it. If somebody has a $250,000 claim, there's a gatekeeper policy that kicks in the other $200,000. And like I said, insurance companies will use it on the reinsurance side.
Sometimes do we use the term stop loss coverage for that type of gatekeeper policy?
Yeah, they will use stop loss. That's called stop loss. And it's actually a casualty policy. Casualty companies write it. Because what it is, it's stopping the liability and bringing a liability payment of the insured, whether it's health insurance or whatever, that fronts it. And but
Right.
that's the easiest way to explain transfer and retention in the insurance world, because they're using it, and the insurance company will retain so much, and they will reinsure the balance. And almost every insurance company reinsures. There's very few insurance companies out there that will be on the hook for the entire book of business that they have. Even the largest ones in the world are going to have reinsurance someplace. It's just one of the features of it. So, the non-insurance risk taker, that a non-insurance risk taker would be a good example. Would be a business that decides that they're going to have their own health insurance, or they may have their own. A lot of them might have employee stock options, where what they're doing is instead of having paying into a 401k for employees or paying for a retirement plan for an employee, they'll offer employee stock, and they take the risk on that because at any point in time that the employee chooses to leave and wants to sell the stock back, they have to buy it. So that's a form of a non-insurance risk taker, or like I said, a business that buys a stop loss policy but is fronting something up front, or if it's a small person, they can do it. If you don't wish to buy automobile insurance, you can go down to PennDOT and deposit $35,000 in an irrevocable trust fund and self-insure your auto. And it's $35,000 per auto. So if you have two vehicles, you have to give PennDOT $70,000. Most people use the insurance, but that would be a non-insurance risk taker. I'm going to do that. And that's to cover the minimum limits of 15, 30, and 5. So, but those are the two primary reasons. Okay. Forecast as the basis for selection. Always the financial consideration What's it going to cost us? What's it going to cost us if we don't implement this plan? What's the plan overall going to cost us if we have to go back to the state and do all our filings, all of this paperwork? And then you have your non-financial considerations, which is just basic work, basic resource time of staff committed to the project, all of those things. It is a technique of risk management, because if the risk manager is looking at implementing a plan, they have to know, okay, what's it going to cost us to implement this new plan? If you're trying to put up a firewall for your IT folks, okay, what's it going to cost us to do this? What's the technology going to cost? Is it going to disrupt productivity? Then the non-financial considerations would be, does it slow business? What's going to be the view of the public if we do this? So you could have public impression, you could have government impression as to, well, why are you doing it? Okay, why do you want to do that? Just like the example you gave on flood. Okay, if Commissioner Miller sends out these surveys and the industry says, well, we're not writing it, and why would we want to write it? But there's a public outcry, gee, well, nobody wants to write it in Pennsylvania. Now you have the consideration, well, it's like a black eye. Okay, so, but there are non-financial considerations. They're just broad. The risk manager will consider them, but they're also weighing heavily on any financial considerations to implement, cost if we don't, cost if we do. Okay. The basic decisions that you're always going to face. There's one of the uses across there is that they use is a technical decision and a managerial decision. The technical decision is basically the workup. Now the managerial decision, it goes up to senior management. Here's the reports. Here's the cost. Here's the cost to implement. Here's the downtime for us to change it, whatever it would be. And now management people have to make the decision. And in large companies, the risk managers are usually in the executive management. They're up there. So you have like your VPs of underwriting, VP of claims, VP of risk management. They're all looking at accounting, everything. They're looking at the numbers on the board, and the final decision will be reached on how they're going to implement it. That's the final managerial decision, looking at all the research that has been done, the analytics that have been done. That's the technical decision. The management decision is go or no go. Or it just may be, well, we have to amend. A lot of times they'll use an approach to making these decisions that they'll look at the area and they'll say, what's the chances of having these claims? Unlikely. We might have them, but we might not. Well, we've had these experiences, so we're going to call it a mid-range. And of course, then you have some claims. We know people are going to wreck their cars. They're going to be total losses. So we're going to have definite and absolute claims, and they analyze all four of the areas, and they try to come up with the approach. Then that's in the technical portion of it. Then the managerial is, how significant will it be? What do we think we're going to cost us to do this? What do we think it will cost us if we don't do it? And what's the downstream effects if we do it to the overall business operation? And as you go forward, any risk manager knows that is not a stagnant business. They can't take a look at, we're in January, so we'll just say they're going to start looking now at 2015 results for the entire year of 2015. Our book of business, we brought in X number of dollars of premium of new business. We had X number of dollars in claims paid out. How much of it was paid on the new business? How much of it was paid on the existing book of business? How much of it was paid on business that's been on the books more than 5 years? Because in most cases, insurance companies make no money on the first year until they the cost of issuing the policy, underwriting the policy, paying the agent, preparing the policy, doing all the research on it. Most cases, companies do not make any money on the first year. So when they're paying out claims on new business written less than a year, they take a hard look at that. What the manager has to do is he takes all of that information in and he takes a look at their present approach, and he has to decide at that point, once he has all the information, what's his presentation to executive management going to be? Are we going to revise our plan? Are we going to stay our course? It's going to be one of the two. We either stay our course, this is what we're doing, and we're doing it okay, or we're going to have to revise something. We're going to have to take a look at, premiums have to be increased, or we're going to take a look at, well, we're going to tighten up our underwriting on homes over 30 years old. We're going to tighten up our underwriting where a person has 2 cars, but they're both over 10 years old. Because these are claims that are coming in, and we don't believe we're collecting the appropriate premium for this type of a loss and that. So it's a revision, and it's an ongoing process, and it will constantly be changing. If you have any questions, shoot them in here on the quick side. If there's like I said, if there's a good takeaway to this, risk management is an ongoing operation, and it requires cooperation of all the players, underwriters, claims personnel, agents in the field. All of that data has to be accurate for that risk manager, who's ever going to do the risk management, to make a determination, because ultimately poor risk management leads to adverse claims, and adverse claims are going to lead to loss of productivity, loss of competitiveness, and maybe loss of business. And by going out of business. So it is, and like I say, it's a very technical business, but it adds definite certainty to uncertain feats. So if there's any questions, fire them in.
Mm-hmm. Well, Jack, I appreciate it. And I think risk management is one of these things, especially when you're new in a company. You may not have as much input initially, but all the work you do is ultimately going to be aggregated in a way to help the senior managers figure out what product lines are profitable for us. How do we address unprofitable profit lines? Should we get into new markets? What are the risks, reputational risks, costs, and so on and so forth. And that's where risk managers really make their money ultimately. And in many instances, and I'll give you the one example, and for some of the more experienced people on this call, or at least in the insurance market, you may remember when Cigna was one of the largest P&C companies in the United States. And as a result of their risk management functions, they had then decided ultimately through their management systems and their executives to actually get out of the P&C business. And that occurred probably about 20 years ago, a little more than 20 years ago in Pennsylvania. But it was all as a result of their risk management tolerance for that particular market. They didn't think they could make the kind of profits, and instead decided to move into the health market. And now we have a situation where they're actually Cigna is now going to be purchased out by another larger health insurer. So Cigna may not actually exist as it did originally. But that's how significant risk management is within a company. It actually helps determine whether a company will survive or will ultimately go away. With that, I want to say thank you to everybody for participating today. I do want to make you aware that all of the presentations for the Virtual Insurance School are available on the PAMIC YouTube channel. You can find that if you go to YouTube and search PAMIC Live, that's 2 words, you'll actually see it there. Today's presentation will be loaded within the next half hour or so, so you'll be able to view that as well. Session 1 and 2 are already there. The next session is February 18th, so we have a little bit of a break, and we'll be covering underwriting and claims basics. So with that, I ask all of you folks to have a safe weekend. I know we're supposed to get some significant snow here, definitely in central Pennsylvania and southeast Pennsylvania. So please be safe in whatever you do. Thank you very much.